Welcome to the Property Profits Real Estate Podcast, the show where real estate investors talk strategy, capital, deals, and growth with your host, Dave Dubeau.
Hey folks, welcome back. Today we have not one, but two real estate entrepreneurs on the call. We've got Mark and Preston. They are partners with Valoran Capital Management. And gentlemen, welcome to the show. Great to have you.
Hey, Dave. Pleased to be here.
All right. So Mark, I think there's a little disclaimer that your lawyers wanted you to say, so let's go ahead with that first.
Sure. Thanks a lot, Dave. So this discussion is for informational purposes only and does not constitute an offer to buy or sell securities or any type of solicitation for securities.
Right. This is all informational. That's all we're looking for sure. All right. So let's just zoom out for a second. And Preston, maybe tell us a little bit about, Valoran Capital Management. What do you guys do in the realm of real estate?
So at Valoran Capital Management, we run a series of closed-ended funds where we invest equity into workforce, most commonly value-add real estate in every state except for California. So we partner with local operators and provide anywhere from 9 to 99% of the total equity in their deals. And we look to partner on deals anywhere from a 1 to 10 year hold, where anywhere from hold and sell to reposition to distressed assets.
Okay, so workforce housing, quite a variety there. What's kind of your typical buy box these days, gentlemen?
The total capitalization is anywhere from $10 to $75 million. Equity checks anywhere from $5 to $20 million. And we try to stick anywhere over 100 units. We like to have some sort of economy of scale at the property, at least, a leasing manager and 1 or 2 maintenance technicians.
Okay, so are these A, B, C, D class buildings? What kind of buildings are these looking like?
Most of them fit in that B and C class. I would say most of our investments are also in secondary and tertiary markets. Like in our last fund, our number one market was Albany, New York, out of all places. So kind of looking for edge anywhere we can find it.
Okay, very good. And Mark, what kind of markets are you guys focusing on? Preston mentioned it's kind of like all across the country, excluding California specifically. I think I know why. But tell me a little bit, what are the markets that you're most bullish on these days, mid 2026?
Yeah. So, if you were going to generalize the country, we really like the Northeast. We like the Rust Belt. We like the Midwest. In a nutshell, it's markets that haven't had a large inflow of supply and are going through lease up. So that excludes parts of the Sun Belt, some of the mountain states. And in general, we're looking for markets that have high household median incomes relative to pro forma rents. To generalize, as Preston mentioned, we're looking for workforce housing. So a $3,000 apartment in New York City is considered workforce. That same $3,000 apartment in Tulsa would be considered luxury or Class A. So we do adjust our buy box relative to the markets.
Okay. Very good. So over the last number of years, everybody knows that multifamily has been a bit of a tumultuous experience for a lot of investors. How, if at all, has this affected you and your fund and the opportunities that you've invested in?
So one would be the general supply in a lot of those booming markets. In previous funds, we had done a lot of business in markets like Phoenix. Those obviously had massive rent growth, massive population growth, and developers saw that, went and built a lot more than the market could absorb. In addition to that, there are interest rates. In some of those previous properties, debt was more of a value driver. As that floating rate debt came down, obviously there's a lot more cash flow, cap rates compressed. So something we have learned from that is use debt as more of an input instead of a value driver. So what that means is taking out fixed rate debt and lining up the term of the debt to the term of the business plan. So if we're going to have a 10-year hold, we're not putting 2-year bridge debt on it. And if we're having, a 2-year hold, we're not going to go put some 10-year agency debt on it.
Okay. That makes a lot of sense. So part of your whole program, you guys, is really partnering up with quality operators, right? Because you don't want to be allocating your funds into not so great deals. So what's kind of your criteria when you're looking at operators and their opportunities?
Yeah, we really like operators who preferably live in the market, but also more importantly that own multiple properties in that market. They just have the nuances as far as who their PMs are, who their general contractors are. They know the brokers. They're very tied in. Nothing scares us more than an operator in New York doing a deal in Arizona. There's a whole country that they just flew over where there could be other deals, and we really like that narrowed down focus. As far as the operators that we like to work with, given the nature of the way we invest, generally our operators are emerging to recently established operators, because generally we find those operators, they're very good at their job, they're very hungry, and they're just lacking capital or balance sheet help to really expand their business. So it really becomes a symbiotic relationship where both parties end up working out well together.
Yeah, so it's really about focusing on people that have boots on the ground in the local area that the properties are in. They've got the infrastructure. Hopefully, they're vertically integrated. Did you mention that you're aligning a lot with newer operators? Is that what you said at the end there?
Yes, we will work with operators. We prefer to see them having a couple deals. They don't need to have a ton of exits, but we need to see some type of proof of process that they get in there, they know what they're doing, and they're looking to do more deals.
Makes sense. So it sounds like there's two big parts to your business. One part is finding those good operators with good opportunities. The other part is filling fund with funds. So what does the capital raising side of your business look like, gentlemen?
Yeah, so from the capital side, all our investors must be accredited. And when we are looking for investors who understand that real estate's illiquid, real estate has a long hold time, there is definitely risk there, but at the same time too, there's opportunity. And so, we understand that private closed investments are not for everybody, but for those who see a fit and a match there, there's definitely some great ways to deploy capital.
Hey there, if you're a capital raiser, a syndicator, or a fund manager, and you're looking for a steady flow of incoming accredited investor leads, then go ahead, grab a free copy of my new book, How to Get 20 Accredited Investor Meetings Every Month Without Cold Calling, Networking, or Chasing People. You can get that at 20accreditedinvestorsbook.com. Again, that's the number 20accreditedinvestorsbook.com.
And what have you found, because we talk a lot about raising capital on the show, what have you found these days that's working well for you guys to connect with investors, with new investors? Obviously, word of mouth and referrals is huge, but what else do you do that you find is effective for meeting new investors in 2026?
Well, transparency is paramount. As much as you can share about the good and the bad of your previous funds, improvements that you made over the years, this all speaks volumes to investors. Your investors understand that nobody's perfect. We've made mistakes. We've also had some great successes. And so by going through that process and sharing and being an open book, that resonates a lot better than essentially just only showing the good.
Yeah, most definitely. So, Preston, maybe you can define for us what is, I believe you're calling it a closed-end fund. That's what you guys are focusing on. Explain that so the average person who hasn't invested in a fund would understand what that means.
Yes. So what that looks like is we'll go out to investors, friends, families, institution, and we'll aggregate an amount of capital. They'll commit X amount of dollars. They'll sign PPN, look at a fund term sheet. And then the fund life for our current fund and our previous funds is 10 years. The investment period is 3 years. So over that first 3 years, we're on a capital call structure. So they will not sign every dollar they commit over to us day one. We'll call it over the span of those 3 years as we find deals, as we need it. So we'll try to break it up over those 3 years evenly, but obviously if we find good opportunity, we'll call it as needed. And then, years, most of the time, 4 to 10, that's what's called the harvest period. So that's where we're executing a business plan and eventually exiting them. And then once that year 10 hits, we should have every asset exited.
Okay, interesting. All right, so that makes sense. So if I understood correctly, the first 3 years, let's say you bring a new investor on board and they commit to, investing a total of $500,000 for even numbers. You won't get the full $500,000 up front. It'll be over the course of those 3 years. Then it's kind of locked in. Then years 4 through 10, that's where they're getting returns and then getting cashed out. Am I understanding that correctly?
Exactly correct.
Okay, very good. And what's the advantage of that structure versus some other fund structures that you have seen?
We think this illiquidity provides opportunity in some of these open-ended funds, NAV funds, evergreen funds. While withdrawals are usually capped, there still is pressure from investors if they want to pull out their money, and then the fund manager will then go and have to fire sale. This ultimate illiquidity allows us to fully complete our business plan over the intended hold period and thus generate risk-adjusted returns.
Okay. Yeah. So it's really about finding investors that are aligned with a 10-year time frame, and they're looking for solid returns, but they don't need to access that cash in the meantime.
Absolutely. We do have investments that will kick off distributions during that whole time, and then we will have investments that we don't see a dollar from until the eventual exit. So we do have to have patient investors who understand the process and understand the business plan at the property level.
So Mark, with everything that's gone through multifamily in the last number of years, I've interviewed a few other operators and syndicators these days, and some of them are very, very enthusiastic about the opportunities that they're seeing coming down the pipeline due to the misfortune of some other investors who've got in over their heads over the last few years. Do you see prices coming down? Do you see better opportunities coming down the pipeline? What's your crystal ball telling you about multifamily?
Yeah, so we see twofold opportunity. One, the stress that you mentioned right there, which essentially is, to make a generalization, that rent growth a couple of years ago was modeled to increase at a higher rate, and interest rates were to remain low. And you plug that into a model, and then it doesn't work out. In fact, it goes the opposite.
Yeah, it
causes a lot of stress in those assets. So yes, that is presenting some opportunities, but at a more broader scale and looking forward, depending on what market you're in, and even at a national level, we're seeing a large drop off in deliverables for new product. And so markets that had a huge amount of supply that's being absorbed. And
like Houston, like Preston was mentioning earlier, right? There's an example.
Correct. And as that gets absorbed, for the same reasons that a lot of those earlier operators that you mentioned are having the need to exit these properties, it's a lot harder to put a shovel in the ground. So fast forward a couple of years here, the product that you thought was going to be delivered in a, let's call it, normal environment is not being built. So therefore, it's not going to be delivered in 2, 3, 4 years. And so we think there's definitely a situation here where that supply and demand is going to flip the other way, where the demand is going to outweigh the supply going forward. So looking at markets that are already supply constrained, it's only going to get worse, we believe.
Yeah. All right. Well, at the time that we're doing the interview, it's already mid-2026. What are your goals? Where do you see you taking the company and the fund over the next 12 to 24 months?
We've been focused on value-add workforce housing since inception. We continue to look for more deals and continue to grow our fund. And then in the process there, we vet opportunities. We like meeting with new operators who bring us opportunities in markets that we may or may not already have a position in. So it's really just a lot of going in there and looking for the right deal at the right time.
Very good. Awesome, gentlemen. Well, this has been very interesting. Congratulations on taking this new venture forward and all that you're doing and all you're planning on doing. If people are listening to this and they want to connect with you, what should they do? Where should they go?
You can email us directly at mark.purtell@valorancapitalmanagement.com. We can spell it out for you, VALORAN capitalmanagement.com.
Perfect. Awesome. Well, hey, Preston, Mark, thanks very much for being on the show.
Thank you.
Yeah, Dave. Appreciate you having us.
All right, everybody, take care. Thanks for tuning in, and we will see you on the next one.
Thanks for listening to the Property Profits Podcast. If you'd like to be a guest on the show, apply at daveinterviews.com.